Right guys, let's get on into it. This is part 2 of the Wyckoff strategy. If you haven't seen part 1 of the Wyckoff strategy, I have linked that video in the comments below. So we're specifically going to be talking about where am I targeting entries in the context of the Wyckoff price cycle. That's going to be around breakouts, and it's also going to be around what I call pivot springs. This video is going to center around breakouts. In a couple of weeks time I may do a follow-up part to this where I explain springs to you. So we're going to be looking at breakouts, and we're going to be spending a lot of time on this breakout here, which is in the context of a phase 2 uptrend. So it's a continuation type pattern. Now if you would like to learn more about breakout patterns, I have a chart model database which is online. It's the first of its kind as far as I know of. There are thousands of breakout setups in there. It is free for 7 days. There's a link to that down below if you are interested in training your pattern recognition skills to more accurately identify what are these continuation type patterns. Invariably they are going to be VCPs, which is volatility contraction patterns, flags, cup and handles, Darvis boxes, so on and so forth. So let's just do an overview, then we'll start going down into the nitty gritty in terms of things you want to be looking for. So we can see the stock over here was in the context of a phase 3 distributional top. It then went into a phase 4 markdown. If you want to know more about the labeling, then you can go and see the part 1 video. So there's a phase 4 decline here, then it goes into a phase 1 base. Now the things that you would like to see in a phase 1 base are preferably a nice spring with a very strong recovery, and then where price tightens up, that would be in the context of phase D, then a really nice breakout powering the stock above key moving averages, which I'll come on to in a second, into the context of a phase 2 uptrend. Quite commonly you'll see within the context of this phase 1 basing pattern, you'll then see a cup and handle form, and in the context of the handle you'll see some VCP, volatility contraction type pattern action, potentially a flag, a Darvis box, something like that. But in essence, when you see these continuation type patterns, you're watching for high lows to form, volume to be drying up as well, price sitting on one or more key moving averages, and then what I call a trigger bar. I'll probably do a video maybe next week, maybe in the next couple of weeks, on trigger bars and what on earth are trigger bars. But again, if you go and you sign up, and it's free for 7 days, that online chart model database, you will just see trigger bar after trigger bar after trigger bar and really start training your eyes to it. But I'll explain what it means from a Wyckoff standpoint, especially supply and demand in a couple of minutes. So price then powers out of this phase 1 base, ideally on very big volume, into a phase 2 uptrend. So in essence, in phase 2 uptrends, you are looking for more volume to be coming through on the rallies, and then when price pulls back down, you're looking for multiple tight candlesticks, maybe there's some shakeout demand tails, the volume to be drying up as well, followed by strong reversals. So from a structural standpoint, you want to see higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and in continuation type patterns as well. That is ideal behavior. Now what I've done is I put this black line on here, which can be magical moving average, whatever you want it to be. So on the daily chart, I use the 10 EMA and the 21 EMA, and then the 50 SMA, the 100 SMA, and the 200 SMA. On the weekly chart, the three main ones that I use are the 10 week, the 21 EMA, and also the 40 week SMA. And then on the monthly chart, I like using the monthly 10 EMA. So let's just imagine this is whatever time frame you want it to be, but for brevity's sake and to not have loads of different lines moving around, I've just used one moving average, which will then help us in terms of the trade management section. So we're going to be looking at things from an identification standpoint, initial controlling a risk standpoint, a risk mitigation standpoint, and then also optimizing profit standpoint as well. So we've got this nice stock. It is in the context of a phase 2 uptrend. Ideally, it's showing impressive relative strength versus the market. It's in a strong industry group. It's the strongest stock within said industry group, or one of the strongest stocks. Preferably, it ticks many of the William O'Neill criteria from a fundamental standpoint: big earnings, big sales, return on equity greater than 17%, fund ownership increasing, high quality growth fund, all of those good things. So then we see the stock starts basing out and building this VCP. Now commonly in a VCP you will see somewhere between 2 and 5 contractions. For the purpose of this example, we have 3 contractions. We have contraction number 1, contraction number 2, and contraction number 3. Now you would like to see the depth of those contractions around about halving each time for a perfect VCP. So i.e. the first contraction could be 20%, the next one could be 10%, and then the final one could be 5%. Now it's not actually going to be, I didn't kind of draw that perfectly, but you can see here because of how we're trying kind of laid it out, we have 10% for the first contraction, and then that middle contraction is around about 7%, and then the final contraction is around about 0.5%. But ideally a halving in contractions each time is very, very healthy. but it doesn't have to be perfect. But you are looking for those contractions to be lessening, and then you're looking for an asymmetric risk versus reward opportunity. So the final contraction being in single figures, because if your stop loss is in double digits, then it's all getting out of whack in terms of the risk versus reward relationship. So let's start talking about what it is you're actually looking for over here when I am then targeting a breakout. So over here, I'm going to shake this and let's put it in, say, an orange. Okay, so we're just looking at this area here. Now this is where we can go into some of the Wyckoff laws as well. So the first one is supply and demand. What it is we're ideally looking for when the stock is powering out here, we're looking for evidence that demand is still well and truly in control and there's limited supply which is coming to the market. So this is then understanding the price cycle. There should have been a lot of accumulation going on here. Really powerful breakout. We see a lot of volume on the up moves, higher highs, higher lows on the pullbacks. We're not seeing much volume. We're not seeing really bearish candlesticks coming through. Then ideally in this VCP, this kind of basing structure here, we're seeing higher volume on the rallies and then volume pulling back on the declines, potentially on the swing lows as well. Within the base, you're seeing gap down reversal bars, you're seeing shakeout demand tails. But as we get in here, as we get over to the final contraction, where price is then consolidating in single figures, ideally that final contraction is sub 7%, ideally actually getting into sub kind of 5%, you then create a much more asymmetric reversal trade. You're on the lookout for extremely tight candlesticks. Now obviously it's on a relative basis. You're comparing the tightness of the stock to the other price history of the stock. You're not comparing this stock to this stock over here or that, or kind of this stock over here. It has to be apples and apples, oranges and oranges, if you understand what I'm saying. So in this final contraction, you're preferably looking for price to be sat on at least one or more key moving averages, and then multiple tight candlesticks, really thin real bodies. I like to use candles, so really thin real bodies in terms of where price is opening and closing the overall spread. So the higher the bar to the lower the bar is narrow as well, and the volume is drying up, and I use the 30-day moving average on the volume. If you want to use the 20-day, the 30-day, the 40-day, the 50-day, it doesn't really matter. You're looking for relative dry ups in volume. So that's what I'm looking for here, and then the trigger bar. And again, it's all in that model database. Just go and look at thousands of them. You'll understand what I mean by a trigger bar. So then I'm looking for a trigger bar. So that's kind of the identification part. Then we want to think about initially controlling our risk. So invariably I will go underneath the final contraction and or recent lows of the stock, which I like to tie in with being below one or more key moving averages. So for this instance here, it's this magical black line. Whatever we want to think of this magical black line on a daily chart, it would likely be the 10 EMA and preferably the 21 EMA as well. On the weekly chart, it may be underneath the 10-week moving average. But for the purpose of this, just to illustrate the point I'm trying to make, just imagine this is moving average, magical moving average, whatever number you want to call it. But I'm going to be underneath the final contraction and underneath this magical black line, okay, this magical moving average. So my initial stop is going to be 5%. So when we've identified it and we've controlled it, now just on the final part on the identification, I invariably use a buy stop limit order with a stop loss attached, and then I use a buy stop limit order with a limit attached, and then also attach a stop loss to it. So for this instance, my buy stop would be at $243.01, and then I'd attach a limit of say 0.5% or 1%. So that means I'm looking to get filled within that half a percent or percent of this pivot point being $243, and attaching the stop loss wherever that may be. That's around $231.50 or something like that. That's how I do the vast majority of my buy orders. So then when we've thought about the trade, we've identified it, thought about how we're going to initially control risk. I do this before I'm even in the trade, is think about the active risk mitigation. So free rolling the trade. What I want to do is take all of the risk out of the trade. I want the stock to do no damage to my account equity line. In essence, I want to lose no money on the position, because as much as this stock here is powered out, then it puts in a high low, high highs, and it makes a decent move. They do not all do that. So I want to position myself. This is a Sun Tzu Art of War quote. Position myself beyond the possibility of defeat as soon as prudently possible. So the levels that I use to free roll are over here. You could sell half of your position at 1 times your stop loss, you could sell 1/3 at 2 times your stop loss, or you could sell 1/4 of your position at 3 times your stop loss. Now your stop loss could be your initial stop loss, or it could be that you are simultaneously selling part of the position, whatever fraction percentage it might be, and then pushing your stop loss up a little bit because the trade evolves. Maybe it goes and puts in another contraction and a shakeout demand tail after your entry. Maybe there's a logical place to push it up by 1%, 1.5% underneath another magical moving average or something like that. So trades evolve. So this is how I then think about it. But for the purpose of this, let's say we keep our stop loss down here at 5%, and then I'm selling 1/3 of my position with a sell limit order at 2 times where my stop loss is, which would be a 10% gain. Now what I invariably do, but it's kind of different how each trade plays out. Invariably, when I have then sold part of my position, I'm looking to move my stop loss up around about break even. I may wait for a bit of a testing action and then a reversal before doing it, but that is then the area where on the remaining part of my position, usually it's 2/3 because I'm invariably selling 1/3 of my position at 2 times wherever the stop is and or pushing it up to. Then I'm looking to push up my stop loss on the remaining part of the position to around about break even. It could be once I'm selling that, it could be after I see a testing action. It really depends how the trade plays out. These are just kind of general principles. If you want to go and get down into it, we do live coaching sessions twice weekly. There's over 100 hours of educational content in there where we go bar by bar, really training this in a deliberate manner if you're interested in going down the rabbit hole. So then once we've sold 1/3 in here, it could be a quarter, it could be half of our position, our remaining shares, we need to have an idea of when are we gonna sell them. So you could use a moving average as a trailing stop for part of the position, as I've indicated here. You could randomly sell into strength if you want to. If you start thinking the stock gets extended, you could go lower the day. But what I do is I keep part of my position back because I'm looking for a large intermediate term trend. So for me, I'm an intermediate term trend follower. I'm trying to ride the intermediate term trend to the best of my ability. Now I never have any idea whether that intermediate term trend is going to be 5%, 50%, hundreds of percent, or if I'm going to get stopped out the next day or in a week. No idea. But what I'm trying to do is position myself in front of enough high quality setups and then try and ride those intermediate term trends. So for me, I'll be keeping some back before we close below this magical moving average. On the daily chart, that's more likely going to be the 10 EMA and 21 EMA. For a slower mover, it may be the 50 SMA. On the weekly chart, it's more likely to be the 10-week moving average, which is then closely aligned with the 50 on the daily chart. But if it's potentially very early on in a basing action, so i.e. coming out of a phase 1 base, I may also use the 21-week moving average as well, the exponential. But again, that's kind of horses for courses, depends where the stock is in its price cycle, depends how it's setting up, depends how quick a mover it is. Is it likely to be a slow kind of chugger? Is it a really volatile biotech stock or crypto related stock, such as like a crypto miner or something like that? So it really depends. You have to apply some kind of common sense to this as well. But for me, intermediate term trend follower, so trying to ride the intermediate term trend to the best of my ability, have then those sell rules in place for how I'm then looking to manage the position. So here, when price closes below this magical moving average, that would be the exit for me. Now we never know whether this is then going to enter a phase 3 distributional top, or potentially it's another continuation type pattern. So if it then resets, so imagine here if I bought this breakout, and let's say I exited the position here, so let's put exit in here. Imagine I kind of free rolled it in here somewhere. This was my exit in here. It actually resets, so I can always buy it back. What I don't want to do is get in a stock that's trending up like this and then just ride it all the way back down like this. Okay, having some form of sell rule. But again, have a little bit of common sense to this. Look at the stocks in the model book. There's thousands and thousands in there. Have a look at them. How do they move? There's stocks on the monthly time frame. There's stocks on the weekly time frame. Stocks on the daily time frame. There's stocks on the 1 hour time frame. Understand how are they moving around these breakouts, even after springs as well. Understand how are they moving, and then create your own sell rules as well. But understand how is a stock setting up. So that's the identification part. How is it best to optimally control risk? There's a lot of content on the in the live coaching session recordings. How do you then want to go about mitigating risk? So thinking about positioning yourself beyond the possibility of defeat. How do you then want to optimize the profits? That's both in terms of overall monetary gain, but also efficiency of said monetary gain as well. But if you go and look at those model book stocks, you will then understand, okay, how do they move, and then you can create some rules for yourself as well. Just then covering off some of the final points. So cause and effect for the Wyckoff laws, really important. In essence, it basically means the bigger the cause, so the bigger the base, the bigger the effect. So imagine if you had this base playing out like this, and this here was on the monthly chart, or we could even say it's the daily chart here, or the weekly chart, whatever. So we actually have a base that starts in middle of 2017 and goes into kind of Jan of 2019 before the breakout. That there is an 18-month base pretty much. that is a significant cause. If you saw a similar setup like this, but it was on an intraday and it was a 5-minute chart or something like this, you would not expect the resulting move to be as large. So you want to be very aware of when you see large bases, especially if they're displaying excellent relative strength as well. So potentially in the context of a bear market, you may see some very large bases building phase 1 bases that are then actually showing relative strength into a potential breakout area. Potentially it's an industry group, it's a theme that's very strong as well. So you want to be aware of the law of cause and effect. So general principle is the larger the cause, the larger the effect to then play out. Effort versus result. This is a real nuance here. Actually, if you want to learn more about that, I'm not going to be able to explain it in a couple of minutes. That there is in the live coaching session recordings to find out about that, because that is going into the weeds in terms of price, in terms of volume, different characteristics you want to be looking for, being very aware of different type of candlesticks. If it's a gap down reversal bar, bearish synchronicity, dojis, hammers, a bull gap pattern, just loads and loads of different stuff. And then it also depends in terms of the context. Where are you seeing that candlestick? Are you seeing it around a breakout or in a potential pivot developing? Are you seeing it after the stock has made a move of 20, 25%, 50%, hundreds of percent? So again, that there is really common sense, but understanding where you are in the price cycle. What is the context? What is the context of the stock? Is it a phase 3 distributional top and it's trying to rally back into a downward sloping moving average and overhead resistance? Is it very early on in a breakout? Is it potential testing action after the breakout? So what I would really encourage you to do is go down the rabbit hole of understanding price cycle, understanding what is going on in terms of the candlesticks, the volume from a supply and demand perspective. As it's a lot of fun as well. Actually, it's kind of a mental challenge as well, but it is very, very interesting. The stocks, which are moving, which aren't moving, which areas are you seeing strength in? What is then the feedback of individual stocks as well? So I'm now going to go into a ramble, which is way too long, so I'm going to wrap the video up there. But hopefully that there was useful for you guys to kind of understand the Wyckoff price cycle a little bit more. Phase 1, phase 2, the type of areas where I'm looking for setups, thinking about how you can identify the trades, initially control the risk, thinking about risk mitigation, thinking about optimizing your profits as well. Those there are the four key areas that I would really focus on improving your trading. So thanks very much for watching, and I will see you in a future video.